This is Steve Kirsch, Pension Committee Vice Chair. I'll be running the meeting tonight. Chairman Mandros will not be present. Go ahead and do roll call. OPEB Chair Mike Vitello.
He will not be here.
Not here. I'm here. Ron Banowski.
I am here.
Dennis Condon.
Dennis is not on OPEB. He's on pension.
He's pension.
Pension.
Pension Committee member Frank Duchess.
Here. No endorsement. Just do OPEB roll call first. It's easier. Do one at a time.
First Selectman Ken Kellogg.
I'm here.
Finance Director Ron Banowski.
I am here.
Jonathan Formicella.
Jonathan Formicella is here.
Pension Committee Representative, Board of Finance, Mike Mandros is not here. Steve Kirsch is here. First Selectman Ken Kellogg.
Here.
Superintendent of Schools Joe Cobsa.
Here.
Jonathan Formicella.
Jonathan Formicella is here.
Jason Mauer. Not here. Dennis Condon. Not present. Chrissy Martinez. Not present. Frank Duchess.
Here.
Thank you. Item 2 from the agenda, review of minutes. The Pension Committee minutes for April 27th, 2023, special meeting. Do I have a motion to approve?
Chairman, I move that the minutes be approved with the following corrections. Jonathan Formicella present. Chrissy Fensor Martinez present. Those are the corrections I have.
I second that, Jonathan Formicella.
Thank you. All in favor of approving the minutes as amended?
Aye.
Aye.
Any nays? Hearing none, it passes unanimously. Item B, OPEB Board of Trustees minutes for April 27th, 2023, special meetings. Do I have a motion for approval?
So moved.
I'll second that.
Moved in second. Are there any discussion? Hearing
No.
none. All in favor, say aye.
Aye.
Any opposed? Hearing none, it passes. Thank you. New business. Item A, resolution regarding principal custody solutions, direction for retirement payment center services for pension. Yeah, I'll ask Ken to go ahead and speak to that.
Thanks. So I move that we adopt, actually, I'm gonna ask, I'll ask somebody else to read the resolutions. It's a resolution to give me authority. Someone on the pension committee would be so kind as to introduce the resolution that's in the box in the memo.
Item 3A.
Yes.
Okay. Resolved that Kenneth M. Kellogg, First Selectman, Town of Monroe, is authorized to execute and deliver on behalf of the Town of Monroe the direction for retirement payment center services agreement by and between Principal Bank, DBA Principal Custody Solutions.
Need a second?
Jonathan Formicella second.
All right. Thank you. So, as everyone knows, we have certain retirees that are still part of the defined benefit plan, which is the majority of the reason why we're here. Those retirees do not have certain online access. Principal Bank, which does business as Principal Custody Solutions, provides those custodial services for the plan. Our HR director, who is here, identified an option to provide online self-service for those individuals with limited ability to change information like demographics and payment information. Principal has provided us with their contract in this regard. It's been reviewed by the town attorney, who provided his opinion, which is attached. One of the questions I asked him to review, typically contracts are authorized per the charter by the town council. However, in the ordinance that established the pension committee. The town council did delegate that authority as relates to administration of a plan to the pension committee, which is why it is before the pension committee for adoption.
Thank you. Is there any questions or discussions? Hearing none, I'll call for a vote. All in favor, say aye.
Aye.
Any opposed, say
Aye.
nay. Hearing no nays, it passes unanimously. Thank you. Moving on to new business, item B, the quarterly investment review.
Okay, great to see everyone. Let me go ahead and share my screen for Mr. Formicola. And everyone in the room should have the book, and just a housekeeping. Don't mind the blue binder kind of thing. This can lie all the way flat, so you don't need to be careful about opening the book all the way. So first order of business is it's not present in this report, but we have exciting news that we've just announced the hiring of a new CEO. So she will start on Monday, July 31st, and this is part of a well thought out and planned succession plan. So earlier this year, our current CEO, Bob DeMeo, announced that he would be moving into the role of chairman. And we began a search for a replacement CEO. So we did engage a national search firm, Heidrick and Struggles. We had an internal CEO search committee. I was part of that committee. We interviewed a number of highly qualified candidates, and Sabrina Bailey rose to the top. So she's fantastic. She comes to us from the London Stock Exchange, but she's also held positions at Mercer and Willis Towers Watson, and has lots of experience in the investment consulting industry. So we think that'll be a great transition in the history of the firm. So folks that have been involved in the pension plan for a little bit longer may be familiar with the name Mark Wetzel. Mark has always been our president. So the legacy FIA, Fiduciary Investment Advisors, who the town hired about 8 years ago, we were led by Mark Wetzel. We joined forces with DeMeo Schneider in 2020. Bob DeMeo was at the helm of DeMeo Schneider. So Bob was CEO, Mark was serving as president. But both of them were, the leadership model was kind of like a player coach model. So both Bob and Mark served clients as well as running the business. And we've gotten to the point where we have about 250 employees, and we're much bigger than we were 15, 20 years ago when Bob and Mark started these independent firms. So it made sense to bring someone from the outside that will be focused solely on running the business, not on direct client service and that sort of thing. So that is a great development. We're super excited about it. Any questions about that? Okay, great. And then hopefully I'll be able to advance. Okay, we did just recently send out the save the date for our client conference. So this year it will be in Boston at the Copley Center, and it'll take place on September 27th with a reception the evening before on the 26th. So hopefully most of you should have received the invitation directly. If you didn't and you'd like to see it, please let me know and I'd be happy to send it to you directly, but we'd love to have anyone there who is interested in joining. So all of that out of the way, let's get into the fiduciary governance calendar. So this quarter, it is a review of the investment policy statement. So we do this on an annual basis, but I looked back through our meeting notes and it turns out that the July 2022 meeting and the July 2021 meeting were both canceled because summer is hard to get a hold of people. So we actually have not formally reviewed as a group the investment policy statement since July of 2020. So it's great to have the chance to review, and we do.
The National Weather Service has issued.
We do believe that the IPS in its current state has all of the elements that we think are crucial when it comes to an IPS. So you'll see that checklist on page 7, and you see a green check mark next to everything that we think is really necessary for an IPS. That being said, we do have some recommended changes to the documents, and there are no changes that we're proposing within the body of the investment policy statements, but we are proposing changes which will require a vote for both the pension and the OPEB to the asset allocation tables that are at the end of each of the IPSs. So I will scoot ahead to those pages. And here on this page that's up on the screen, you'll see the current IPS for the pension plan. And then on the next page, you'll see the proposed IPS. So let me just give kind of a big picture review of what we're doing here. So first and foremost, you may notice that we're taking out the target weight column. And the reason that we're proposing removing that target weight column is because we think that it's administratively burdensome to come to the group and get approval each time the target asset allocation changes, even by a slight margin, to have to get approval and update this appendix to the IPS seems a little bit unnecessary. So instead, we would like to rely on the minimum and maximum weights for each of the asset classes. So that's item number one. It doesn't actually really give us any more flexibility as it pertains to managing the portfolio. We're still talking about the same basic guidelines, but instead it just doesn't have that target weight column where, if we make a slight adjustment like we did, for instance, at the beginning of this year, we don't want to be perceived as potentially being out of compliance with the IPS.
Well, it looks like you're also narrowing the gap between minimum and max in several of these so that the flexibility, you still have the flexibility, but we're not this broad range.
Slightly curtailed. Yeah,
Okay.
That's exactly right, Frank. And then we have changed the order of the asset classes. So that's why it looks on page 7 as if there's a lot of changes happening, but it's actually just we're putting fixed income first. But you'll notice that we also are updating the benchmark indices. So for instance, we previously had the Citigroup World Government Bond Index listed as one of the indices for fixed income. We're just going to be comparing the fixed income against the Bloomberg Barclays US Aggregate Index, which is the broadest proxy of fixed income. Similarly, on the domestic equity side, previously we had it broken out into the S&P 500 and the Russell 2500. Instead, we're just going to indicate in the IPS the Russell 3000, which is an all-cap index. So just minor changes, again, does not change the flavor of the portfolio, doesn't change the way that we will manage the portfolio or make recommendations. But we think that this is an asset allocation table that will be less likely to necessitate modest changes over time. So do we want to go ahead and vote on this one, and then I'll talk through the OPEB?
Yeah, originally it was that would have been item C, and I had a motion prepared, but since we're doing it as part of the report, I think we might as well just do it
Okay,
now. So
sure.
I'll just go ahead and make the motion and ask for someone to second it, and then we can discuss it. For item 3C, change the asset allocation. I move to update the Town of Monroe, Connecticut defined benefit pension plan investment policy statement having a last approval date of July 23, 2020 by replacing the target asset allocation table, Appendix A, page 7, with a new table entitled Appendix A, updated July 2023, which new table is included in the published materials for this meeting.
Second.
Second by Frank. Duchess, discussion. Any discussion
Hi,
from
all.
the folks?
Jason Maurer, just here. I just logged on. Just wanted to let you know I was here.
Well, thank you, Jason. And 6:15-ish. Anybody questions in the room? There being no questions, all in favor of making this change, say aye.
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 Any opposed, say nay. Hearing none, it passes unanimous.
Thank you very much. And moving on, we are recommending similar changes to the OPEB asset allocation table. And so you'll see on, again, it's shown as page 7. It's up on the screen, and in the hard copies, it's page 23 at the very bottom right. So again, we are removing that target column, and rather than using the category name of alternatives, we are explicitly stating that it's real estate that we have exposure to. And with this asset allocation table, all of the benchmarks were the benchmarks that we prefer to use. So there are no changes to any of those indices.
I cannot make a motion because I'm pension
You're not
committee. I
yet.
need an OPEB member.
So I'll move that the Monroe OPEB investment policy statement be amended as follows. Appendix A, the word alternatives shall be replaced by the term real estate.
Do I have
Jonathan
a second?
Formicello, second.
Thank you. Any discussion? Hearing none, I'll call for a vote. All those in favor say aye.
Aye.
Any
Aye.
opposed, say nay. Hearing none, it passes unanimously. Thank you.
Okay, wonderful. Okay, and then just a couple other governance items before we move to the capital markets. So here on page 24, you'll see this kind of broad review of governance and oversight. Governmental plans are not subject to ERISA, but ERISA is generally considered a best practice when it comes to oversight of retirement plans. So if you speak with an attorney, they will generally recommend that you follow ERISA guidelines, and then that way you are protected. So the 5 key duties, according to ERISA, are the duty of loyalty, the duty of prudence, duty to diversify investments, to follow plan documents, and to avoid prohibited transactions. So the town of Monroe is doing all of those things or not doing them based on what the duty is. So I think that, you know, you're certainly covered from a governance perspective. You're following all the appropriate procedures. And then on the next page, page 25, we just have an overview of committee or board best practices regarding the structure and makeup of the committee, governance practices, and then documentation. And again, the town of Monroe is doing everything that is required. You have all the appropriate guiding documents in place. We just reviewed the investment policy statement, which is in great shape. The meetings are very well attended. You generally have a quorum. You don't vote without having a quorum. So everything that needs to be done, the town is certainly doing. So no recommendations to adopt any new governance practices or change anything about the way that you've been operating.
Okay, I'm going to plead ignorance. ERISA, what does it stand for?
Employee Retirement Income Security Act.
Thank you.
You're welcome. All righty. So finally, before we get to the capital markets review, we just have a little snapshot of the most recent funded status of the plan. So the valuation reports are conducted every other year. So 2022 was the most recent year. And if you compare the 2022 results to the 2020, you can see that for both the town pension plan as well as the Board of Ed plan, the funded status improved quite dramatically, which actually is even more impressive given the fact that in midway through 2022, assets were, where it had been hurt pretty badly. So you see an improvement of almost 5 percentage points in the town plan and over about 7 percentage points in the Board of Ed plan. So great progress being made. And the actuarial return assumption is at 6.75%. So that's something that we've talked about over the years is, relative to other municipal plans throughout the state. How the town of Monroe's funded status stacks up, how your actuarial return assumption stacks up. Your return assumption is right in line with the average. So we are happy to see that the average has come down over time. It used to be quite a bit higher than 6 3/4, but now you're about on par with where most towns are. but your funded status is much healthier than most plans. So the average municipal pension plan in the state is about 75% funded or so. So you in the high 90s are in much better shape. So it's always good to look strong compared to peers. And then the OPEB plan, OPEBs are a little bit different because there's, OPEB plans are still very new. And so you're still in the process of funding this. But with the funding that you've provided over the past couple years, you can see that the funded status has improved drastically. And the return assumption that's used for this plan is just slightly lower at 6.5%. Any questions on any of that?
These numbers are from 22 or 23?
22. They only do the valuation report every other year. And even when they do it, it takes a long time to come out. I'm sure you've experienced that. Okay, great. So let's move on to the capital markets. It was a strong quarter in the markets. It's been a great first 6 months to the year. But one of the things that's pretty interesting when we look at market results. So for instance, if you look at the graph on the top right-hand side, you can see that in the navy blue bar, that the year-to-date return of the S&P 500 is almost 17%, but there has been very narrow market leadership. So you may have heard of the Magnificent Seven. It used to be called the Fangum stocks, and now they've added a couple new names. I've heard the Magnificent Seven referred to as Tan Mama. So Tesla, Apple, NVIDIA, Microsoft, Alphabet, Meta, and Amazon. Did I already say Amazon or Apple?
No,
So,
no.
okay. The A's are Apple, Amazon, and Alphabet, which is Google. The M's are Microsoft and Meta, which is Facebook. And then you have NVIDIA and Tesla. So those are the Magnificent Seven. They've really been driving most of the strong performance that we've seen this year. If you take out the top 5 names of the S&P, which right now make up almost a quarter of the index, the return of the S&P is closer to 7%. So still nothing to scoff at, such a strong start to the year, but not nearly those, high double-digit returns that we've seen when we include those really big tech names. So that's kind of an interesting phenomenon. Who's to say whether or not it will continue? We do have passive exposure within the large cap equity space in your portfolios. So you're getting the benefit of that, that narrow market leadership. But a lot of that is driven by AI, which is a huge trend in the market and probably will continue to help propel markets forward. But certainly that's not going to be the only thing that works at all time. So anyhow, been a really strong start to the year. And the expectation is that the Fed is at the end or is nearing the end of the Fed rate hike campaign. They raised by another 25 basis points yesterday. That was very much expected. And, it's been kind of interesting to look at how investors have been positioning themselves versus how the Fed has been talking. So the Fed has continued to take on a very hawkish tone and has said, we're willing to continue to raise rates as long as inflation is above our 2% level. They want to cool down the economy. The labor market is still very tight. So the Fed is being very hawkish in their tone, but investors seem to largely be disregarding it. And a lot of folks are still expecting that the Fed will begin cutting rates by the end of the year, even though Jay Powell has said that that they have no intention of doing that. So it'll be interesting. There's a phrase, don't fight the Fed. And the broad investor base seems to wanting to be fighting the Fed and trying to call their bluff. So, I'm not going to speculate as to whether we're at the terminal rate right now, but with the raise yesterday that brought the Fed funds rate to 5.25 to 5.50. There's always a range. And if you look at this chart on the bottom right-hand side, what this shows is that in previous rate hike cycles, when the Fed funds rate has gotten higher than the inflation rate, that has been the terminal rate. So again, we're not saying that we're at the terminal rate right now, but the Fed funds rate is higher than inflation. So what you see on this page says that the Fed funds rate is at 5% and that inflation is at 4%. Since the printing of these books, we've gotten a new inflation reading at 3%. So it's continuing to come down, and the Fed funds rate is at 5.25. So if history repeats itself, we should be pretty near the end of the rate hike cycle. And there's still a lot of speculation about the state of the economy and will we or won't we get into a recession, and when will that happen? We just got a GDP number this morning that was much stronger than people were expecting. So it came in at 2.4%, and I think expectations were at about 1.8%. So that is certainly indicative of the possibility that the Fed has achieved a soft landing, but we're not there yet. And if we look at some of the leading indicators on the bottom left-hand side of this page, you can see that there's been significant contraction. So the leading indicators index has contracted for the last 15 months. So generally, those leading indicators are what we look to signal a recession. So the jury's still out. Broad consensus is if we do enter a recession, it's likely to be pretty modest and not all that painful. If we look at page 30, this is the broad economic review. We've got some good news and we've got some bad news here on this page. So on the top left-hand side, as we already mentioned, inflation continues to come down. It's shown as 4% on this graph, but has since come down to 3%. By far, the largest component of inflation now is shelter costs. And the way that shelter costs are measured within the CPI number is kind of a wacky data point, and it's very lagged. So it's called owner's equivalent rent. And what they do is they call up homeowners and they say, if you were to rent out your house to someone else, how much would you charge? And they only make those calls like every 6 months or something. So it's a bizarre number, and it makes up a huge portion of CPI. So they should change the way that they go about doing it. But because of that process, the shelter costs within CPI are very much lagging. So we've seen other areas of inflation come down pretty quickly, but that shelter cost is still pretty high, and we should start to see it turn over soon. So lower inflation is a good thing. Tight labor market, good thing or bad thing, depending on what perspective you have. It's good for employees. They've got a lot of power and, demanding stronger paychecks, and then better paychecks leads to a better consumer. But a very tight labor market is, of course, hard for companies and for the people that employ those workers. And then on the weaker side of the coin, when we look at the economy, some of the things that are, flashing, perhaps warning signals. Of course, we've got tightening financial conditions with higher interest rates. It's more expensive for both consumers and companies to borrow. So and that's by design. That's why the Fed has been hiking rates, is in order to slow down the economy. But we've also seen a bit of evidence that the consumer, which has been in a really strong financial position, that financial strength is starting to dissipate a bit. So credit card debt is creeping up. A lot of those excess savings that folks built up during the pandemic have started to be spent down. So the consumer is not quite as strong as it was a few months ago.
Just a question on that with the rates being increased, because we saw with the last year, I can't remember, it was earlier this year, but the banks that, had an impact with the tightening and everything. Do you see that with any other banks having an issue with the rate increase?
Yeah, that's a great question. We think that the bank crisis is basically over. So that was a pretty unique position that those handfuls of banks were in that they it wasn't good balance sheet maintenance. So they had all of these, Silicon Valley Bank in particular is a big funder for venture capital. And they had a huge influx in a short period of time of a lot of cash coming in. So they put that cash to work all in longer dated treasuries. And then when rates went up, right. So they took, if they had built up those exposures over time as interest rates were changing, it wouldn't have been as painful, but because they had so much cash come in at once, they invested it all at once, and then rates rose. That's what put them in such a vulnerable position. Most banks have much less concentrated business risk. So they don't, there was a ton of venture activity happening, which led to those big inflows. Most banks have their risk exposure spread out among many different industries. So those were kind of unique examples. And we think that by and large, the banking sector is in pretty good shape.
And they laddered their T-bills like.
Exactly.
Like we do.
Yeah.
That's right.
It would have been all set. That's right.
Just ladder.
Yeah.
So if we look at page 31, here you can see the asset class returns year to date. The bars represent the year to date numbers, and then the bubbles represent the performance for the second quarter. So what you can see, again, very strong start to the year, in particular across the equity markets. So again, we have that really high return for US large cap equities. If we did look at, for instance, the S&P equal weight index, we'd really be looking at a return of about 7%. Very strong returns from international developed markets as well. The US dollar has been weakening a bit, and that is a tailwind for international markets. So that has helped boost international equity returns. But really across the equity universe, very strong results. Fixed income has been good so far this year. The only negative asset class return so far this year was commodities, which again is largely driven by energy. Energy prices are coming down. You may remember that in 2022, when this chart basically looked like a mirror image where everything was negative with one exception, which was commodities. So that's why you have diversification. All right. Does anyone want to talk about any other topics in the capital markets? I'm happy to go into any of these charts, or we can just skip ahead to the portfolios. Okay, skip ahead. So if we move to page 38, this is the snapshot of the town pension plan. And basically everything that we review for the town plan is essentially identical for the Board of Ed plan. So if you look on the top left-hand side of the page, you can see the results of the plan across many different time periods. And we also show the results of the benchmark against which the plan is measured. So what you can see over the past 3 years, very strong performance in both an absolute sense as well as a relative sense. So portfolios posted strong results, and then also compared to the benchmark, we're ahead of the benchmark, which tells us that the active managers that have been selected have outperformed their respective indices. So that's great news. And also, if we hearken back to what we're trying to achieve, which is returns that either meet or exceed that return assumption, and remember the return assumption is 6.75%. You've done that over the past 3 years, but haven't quite achieved that on a 5-year basis and since inception basis, because when we look out over those longer term timeframes, we've got some pockets of weakness there. So you're a little bit behind that bogey on a longer term basis, but the last few years have been quite strong. And it's really quite remarkable to look, especially at the 1-year return up 11.1%, when if you think about the 2022 calendar year results, bond markets were down 13% in 2022. S&P was down 18% in 2022. So a diversified portfolio was down in the mid to high teens, and to have bounced back so much over the course of the last 6 months is pretty encouraging. I'm not going to say that it'll continue upward forever, but we like to see that reversal. So if we look at the asset value, you can see that on the top right-hand side of the page. So we ended the quarter at 14.28 million in the town plan. And if we look ahead at the Board of Ed, the Board of Ed is at 14.52 million. So I just glanced at page 53, but you don't need to move ahead. And one other thing that I wanted to call your attention to is if you look at the asset allocation chart in the bottom right-hand side of page 38, or if we move ahead and look at the next page, which is just a kind of zooming in on that asset allocation, you'll see that we have a pretty substantial cash allocation. This was just really a case of a point in time. So the annual contribution was made right before quarter end, and then we invested the majority of it right after quarter end. So first week of July is when those trades went through. So just to give you a refresher of the way that we generally handle cash is we like to have about 3 months worth of pension payments on hand at all times. So we generally, in this case, we had a contribution come in, so we just left that in cash. Most of the time we have to raise cash. So we'll raise enough cash to fund three months worth of pension payments. We draw that out over the course of 3 months, and then we build it back up again.
What sort of return are you getting on the cash these days?
I am not sure so your assets are held at principal, and I don't know what their money market is returning. At Schwab, a bank sweep is still basically zero, but the money market fund is 4.5% or so.
Okay.
So I can follow up with principal to find out what their
I'd be
sweep is
curious.
yielding. Yep, let me make a note for myself. It's a valid question. And usually, we're not holding a ton of cash, but every little bit of yield helps.
Yeah, because
So,
right now our sweep on our accounts, we're running at about, I think, as of today, it was like 5.17.
okay. Yeah, that 4.5% was actually as of a couple months ago at Schwab, so it probably is higher now.
Yeah.
So yeah, let me check with principal and I'll report back. All right, so if we move on to page 40, you can see the holdings within the portfolio. So this looks under the hood. So for instance, that 25% target allocation to fixed income, what underlying funds comprise that fixed income allocation. So you can see all of those mutual funds here on page 40. Remember that at the beginning of the year, we did make a couple changes, and namely, most of those changes were within the fixed income allocation. So we introduced the Fidelity Inflation Protected Bond Index. That's a TIPS fund. Modest exposure, only 1.5%. But as inflation remains high, we think that this is going to likely be a strong holding for the portfolio, but it probably is not going to be the type of thing that you see, 3-4 years down the road, probably on the more temporary side. MetWest and Baird are the two most traditional fixed income managers. So those will be most similar to the aggregate index. And then we have the BlackRock Strategic Income Opportunities Fund, which is a flexible, it's called an unconstrained fixed income fund. So that's been a good performer. Given the fact that we had higher yields coming into the year, we reduced that BlackRock exposure and increased the more traditional bond exposure because we're getting more bang for our buck there. And then Dodge & Cox Global is a relatively new fund. It replaced the PGIM Global Total Return Fund, which had underperformed, and we weren't happy with that fund. So Dodge & Cox has been a great addition to the portfolio. On the domestic equity side, the majority is indexed. So we have the Vanguard 500 Index Fund that replicates the S&P. That's 28% of the portfolio. And then we have active management on the small and mid cap side, both value and growth. So Diamond Hill is a value manager. Conestoga is a growth manager. Both of those have outperformed their indexes as well. And then on the internet, But the emerging markets manager has been placed on watch status by our research group. So one of the portfolio managers, it previously, Harding Loevner was previously managed by 2 PMs. One of them unfortunately became ill and stepped down several years ago, and he actually passed away earlier this year. His co-portfolio manager became the sole portfolio manager. And since that time, we've seen a deterioration in the performance. And we've also seen what is actually more concerning is some unexpected performance. So in market environments where their strategy should really shine, they have not shined. So we've been keeping an eye on that. And then earlier this year, that PM announced that he'd be stepping down, and someone that's pretty new to the strategy has taken over as portfolio manager. So we're just not comfortable with that amount of organizational change. So that has kind of created a waterfall effect wherein replacing Harding Loevner, we have some other changes that we'd like to make so that we can make sure that the international portfolio has complementary strategies. So I'll get into that recommendation when we get to that part. But just to wrap up the portfolio conversation, the last holding is the Principal Diversified Real Asset Fund. We have a 5% target. That's the diversified real asset exposure. It has exposure to TIPS, commodities, natural resource equities, infrastructure, and real estate. So it's kind of a one-stop shop for real assets. So any questions about the portfolio positioning or anything that's currently in there? All right, so I'll just make a couple comments quickly about performance, which has, again, been very strong in relative terms. So if we look at between pages 43 and 45, we have asset class composite results, and then underneath that, we have all of the individual underlying managers. So what you can see is if you pay attention to the composite results that are shown in kind of these dark blue lines, you can see that of course, we look at performance on a quarterly basis, but really it's the longer term results that are more meaningful. So you look at year to date, 1 year, 3 year, 5 year results. Fixed income is across the board over every time frame, substantially outperforming the Barclays Aggregate Index. Now, you look at the 3 year results and they're still negative because think about the interest rate environment. I looked at the 10-year yield as of 3 years ago. It was less than 1%. And now the 10-year yield is at about 4%. So when you have rising interest rates, that means you have falling bond prices. So that's been the headwind for fixed income in an absolute sense. But what's positive is that on a go forward basis, now that interest rates are so much higher, you're getting a bigger coupon from those fixed income holdings. So we're optimistic about fixed income going forward. If you look at the domestic equity results, you can see that they're ahead on the year to date, 1 year basis. 3 and 5 years about in line with the benchmark. And again, if you look underneath, the Vanguard 500 index is always going to match the performance of the S&P. But Diamond Hill has been a stronger performer. They're ahead on a 5 year basis, kind of benchmark like for most other timeframes. And then Conestoga year to date up 19.2% versus 13.4 for the benchmark. Strong results on a longer term as well. So those active managers have helped provide some value. And then the international equity, you see again some strong performance on a year to date and 1 year basis. Just 1 year modestly ahead of the benchmark. But again, that's where we are going to be making some changes. So Dodge and Cox, we added last year. That replaced Lazard, and they've had a great year. You see that they're about 2.5 percentage points ahead of the benchmark on a 1 year basis. MFS is also ahead. We are recommending replacing MFS, and I'll talk about the rationale behind that. But if you look at the results, it actually could be quite a good time to sell that fund. So sometimes it can be hard from a behavioral finance standpoint to sell a fund that has performed well. But it's certainly preferable to selling at the bottom when they look lousy compared to
So
the
you're gonna
benchmark.
talk about why you're recommending it later?
Yep.
In the next, okay.
And you're looking at moving on both of those, MFS and Harding Loevner.
Correct.
Right.
Yep.
Yes.
Yep, and Harding Loevner is the one that really was the catalyst behind the other recommendations. And that was the one that had the PM turnover.
Right.
And yeah, and Harding Loevner has actually recovered well on a year-to-date basis. They look great, which has made their 1 year number look great, but 3 and 5 year, they're decidedly behind the benchmark. And then that principal diversified real assets fund.
Just
Yes.
one question on the Harding Loevner. Now, that change that we see in the quarter to date, the year to date, has the new manager come in and taken place? Is that the result of the new manager, or don't we know that?
It's a valid question. I don't think that it is indicative of that.
Okay,
And our research team, the research team tends to place more emphasis on qualitative research rather than quantitative. So what they're doing is having conversations, talking to the managers about process and philosophy. And there just have been some things that they're uncomfortable with Harding Loevner. So we're happy about the strong performance, but it doesn't change our feeling about them. Okay, so if folks are amenable to this suggestion, I would say that we should move ahead and vote on the pension recommendations, which are shown on page 67. So let me scoot ahead. So again, the catalyst behind all of these recommendations is our desire to replace Harding Loevner. Now, I mentioned earlier that the way the portfolio is comprised right now is with 3 managers. You have Dodge and Cox on the international developed side, has a value approach. MFS on the international developed side has a core approach, so no style bias. And then Harding Loevner on the emerging markets, which has a growth approach. So between Dodge and Cox and Harding Loevner, they kind of balance each other out style-wise. But now that we're getting rid of Harding Loevner, what the research analysts that focus on the international space prefer is to have complementary managers in both international developed and emerging markets. So we would like to replace Harding Loevner with a pair of managers, ARGA, which has a value approach, and GQG, which has a growth approach. And then we'd like to replace MFS with John Hancock International Growth, because the John Hancock Fund is a better complement to the Dodge and Cox Fund, which has a value approach. So it's really more the Harding Loevner Fund, we think we need to move away from because of our lack of conviction in the strategy. And on the international developed side, from a portfolio construction standpoint, and the fact that we try to think holistically about the portfolio and choose strategies that complement each other rather than selecting strategies just in a vacuum, that's what kind of dictates the recommendation to move away from MFS and into that John Hancock Fund. So
the assumption in all 3 would be that they have both good short-term records as well as long-term track records.
correct.
Okay.
Yep. So the John Hancock Fund is actually, it's a sub-advised fund. So the underlying investment manager is a firm called Axiom. They've done a good job. We've got supporting documentation for all of these recommended strategies. All 3 that we're recommending, the John Hancock, the ARGA, and the GQG, fairly concentrated portfolios. So generally somewhere in the neighborhood of about 50 holdings or so. So that means that, the investment teams are doing significant fundamental research They've got folks on the ground in these countries that are researching these companies. They know the names very well. It's not like a quantitative approach where they're going to have, 600 names in the portfolio. So we tend to like portfolios with that level of conviction. And also the way that our manager research group works is they have their recommended strategies in each asset class, and those strategies are always ranked according to preference. So these 3 names that you have as proposed additions to the portfolio, they are the #1 pick in each of the asset classes. So these are the strategies that our group has the highest conviction in. So I'm happy to talk in more detail, or we can vote on what is shown on this page.
And you see the analysis behind on each of those, both the ones going out as well as coming in.
Correct.
Okay.
Well, with that said, I see Argo, but I didn't see BQG. Am I missing that?
Yep,
Yeah,
GQG
it's
is in
okay.
there.
What page?
Page before that.
Yeah.
Oh, before.
Yeah.
Yes.
Oh, that's- okay, thank you.
Does anybody have any additional questions? Okay, then I will entertain a motion to execute on what has been recommended. Anybody like to make a motion?
I make a motion to accept the recommended changes to the pension fund as outlined in the document in today's meeting.
Second.
Thank you. We have a motion and a second. Do we have any more discussion? Hearing none, I'll call the question. All those in favor say aye. Aye. Any opposed, say nay. Hearing none, it passes unanimously. Thank you.
Okay, great. So we'll work on putting the documents together. And then the last order of business is the OPEB portfolio performance. And because this portfolio is all passive, it's, it's a quick review. So here on page 80, you can see we've basically tracked the benchmark for most time periods, which is what we would expect with an all passive portfolio. One thing that I would point out is the inception summary of cash flows on the very far right, the top right corner. So this plan started with only 700,000 in assets, but over time you've continued to contribute to it. So with 1.2 million in net contributions over the past about 5 years or so, that's brought you to the current value of 2.2 million. Similarly to the pension plans, we did have a very significant influx of cash right before the quarter end, and then that was put to work very early in July. So you'll see on page 81, a cash balance of 11% of the portfolio, about $245,000. That since has been brought down substantially.
And those were the EDEC payments that were made.
Yeah. Yep. So performance in line with benchmark. I think that we have gotten to the size now, just over 2 million, where we could consider adding some active management to the portfolio. So I think I may come to next quarter's meeting with a recommendation, probably to start on the fixed income side, which is where we tend to think that active management can add the most value. And we'd probably see some of the same names that we see in the pension portfolios, perhaps MetWest and Baird as a pairing. So I'll follow up with that, but the passive portfolio has served you well so far.
I mean, that we could obviously stay with that if we.
Sure.
So chose.
Yeah, absolutely. Yep. So no recommendations for any changes at this point in time.
Great.
So that is it for me.
Does anybody have any further questions or anything else they want to discuss tonight? And hearing none, I'll take a motion to adjourn. So move. Thank you very much. We are adjourned at 6:56.